Most investors want to make the best investment decisions they can. They need to be fully informed about how well a company is performing today, but more importantly, how it's going to continue performing tomorrow. The one thing that they don't know much about at the moment is maturity analysis. It's a fresh perspective on how companies perform. We hear the phrase seeking alpha a lot in the investment community, but true alpha comes from finding the opportunities that other investors have found difficult to unearth. One thing we do at OMS is to look at potential performance and try and predict future performance. The way we gauge performance from an investment point of view is by using our exemplar Toyota, and when we give a company a AAA rating, it says that this company is more likely to perform better in the future than competitors at a lower rating. If we take the FTSE 500 as an example and ask the question, how are they performing at the moment, and measure their performance on a 1 to 10 scale, 10 being the best or the highest value, we are bound to find that there's going to be a bell curve in the market. And every company, whether it's in the FTSE 500 or whether it's in the S&P 500 or whatever, will be somewhere on a bell curve scale. And in the middle, we would call the performance of these companies average. One investment manager said to us at a recent meeting that most companies are mediocre. We think what she meant was that most companies are in the middle of the bell curve. But actually, every now and again, a new company comes along and it completely changes the curve, it changes the scale. It performs at such a high level, in this case, in Toyota's case, because of the way it manages its human capital, that it leaves not only its competitors behind, but it actually leaves the whole market behind in terms of management philosophy and management capability. Now, as soon as you get a better performance like that and you try and superimpose it onto a normal bell curve, what you actually have to do is stretch the 1 to 10 scale so it covers the highest performer on the scale, in this case Toyota. And all of a sudden, what used to be described as average or mediocre is now below mediocre, below average, because what Toyota has actually taught a lot of companies is how to perform better, but very few companies have managed to replicate Toyota's performance because their inability to manage human capital to the same standard. So we call Toyota our 10 out of 10, but as soon as we introduce that to the bell curve, it makes everybody else's performance relatively lower. So a company that used to be 10 out of 10 is actually now only 8 out of 10 on this scale. And so if you want to look for true alpha, you need to be looking to get a AAA rating on the OMR rating index. So what does this mean for you? Well, as a CEO, you need to know whether your company's performance is relative to your competitors. As a fund or investment manager, you could be asking companies in your portfolio to answer questions about their maturity. And as an investor, you would benefit from knowing which companies are actively raising their maturity rating or OMR. Please contact Stuart Woolard at omservices.org for further information.